I've watched hundreds of people fail the SIE Securities Industry Essentials exam, and it almost always comes down to the same handful of things. I remember sitting for my first industry exam and thinking the textbook was written in a different language. It's easy to get caught up in definitions that feel like they should be one way, but the exam sees them differently. Let's clear the... Okay, quick reset. You're going to hear people say, here's the exam day version. The examiner is going to ask you about the maximum potential loss for a common stockholder, and they'll throw unlimited in there as a distractor. You'll hear people say owners are responsible for a company's debts, but the truth is your risk is strictly limited to the amount you invested. Think of it like buying a ticket to a movie. If the movie is terrible and the theater goes bankrupt, you lose the price of the ticket, but they can't come to your house and take your couch. The thing nobody tells you is that this limited nature is exactly why the stock market works for regular people. Why would you ever buy one share of Apple if it meant you could lose your house? Exactly, you wouldn't. The test loves to swap these two. An examiner will ask which one is long-term and above the current market price, hoping you'll pick rights because it sounds more positive. Here's where that breaks down. Rights are short-term and at a discount, while warrants are long-term and at a premium. I like to think of warrants like a warranties on a car. It lasts a long time. What I see students do is get confused because warrants start out of the money. Why would you want that? Well, you're betting the stock will skyrocket later. Rights are just about keeping your percentage of ownership when new shares drop. You'll hear people say that if a company makes $1 billion, they have to pay a dividend. Nope. The truth is, dividends are never guaranteed. The examiner will phrase a question about who decides the dividend, and they'll put the shareholders as a tempting wrong answer. It's actually the board of directors. I once had a student who was furious that their favorite tech stock didn't pay out, but that company was just reinvesting to grow the stock price instead. It's a trade-off, not a legal requirement. Here's the exam day version. There's a myth that if you can't fly to the annual meeting, your vote doesn't count. The truth is, that's what proxy voting is for. The examiner will ask how a shareholder can influence the board without being physically present. Most people just click mail-in ballot and forget it, but in the industry, it's a huge deal. It's like an absentee ballot for investors. If you don't vote, you're essentially letting the current management stay on autopilot, right? Now, here's the thing about bonds. Most people think they're boring and safe. But on the SIE, bonds are where the math gets weird and the relationships go backwards. Let's look at the debt myths. The examiner will ask what happens to a bond's price when market interest rates rise. The logical but wrong answer is that the price goes up too. In reality, they move like a seesaw. When rates go up, existing bond prices go down. Think about it. Why would I buy your old bond paying 3% if I can get a new one paying 5%? I'd only buy yours if you sold it to me at a discount. Quick context here. The reason the Fed moves these rates in the first place is usually to fight inflation. While we're on this, just remember that the Fed funds rate is the one the banks charge each other. It's the heartbeat of the whole system. You'll hear people say issuers can take your bond back whenever they feel like it. The truth is, most callable bonds have call protection periods. The examiner will ask when an issuer is MOST likely to call a bond. The distractor will be when interest rates are rising. Actually, they call them when rates are falling. Why? Because they want to refinance at a lower rate, just like you'd refinance a mortgage. It's a real-world application of saving money on interest. If you're the investor, this is annoying because you're losing your high-yield investment right when the market gets cheap. So, watch this. There's a myth that if you buy a bond midway through the year, you get all the interest for that period. Not quite. The truth is, you have to pay the seller for the days they held the bond. The examiner will ask who pays whom in a bond transaction. The buyer pays the seller the accrued portion. I remember thinking this was unfair when I first studied it, but it's just like splitting a utility bill with a roommate based on how many days you actually lived in the apartment. It makes the math clean. So let me put it another way. People say all government debt pays semi-annual interest. Here's where that breaks down. T-bills don't pay a coupon. They're issued at a discount. The examiner will ask how an investor realizes a profit on a treasury bill. The answer isn't interest checks, it's the difference between the purchase price and the face value. It's like buying a $100 gift card for $95. You don't get interest, you just get the full $100 later. Simple, but it catches people every time. Okay, let's talk about mutual funds and ETFs. People use these terms interchangeably in real life, but on the exam, that's a one-way ticket to a failing grade. Stay with me here. So, watch this. The myth is that you can day trade mutual funds like you're on Robinhood. The truth is, mutual funds use forward pricing. The examiner will ask what price an investor receives when they sell their shares at 2:00 p.m. The distractor is the price at the time of the trade. The real answer is the next calculated NAV, which usually happens at 4:00 p.m. I remember a student named Marcus who was a pro at trading crypto. He came into the SIE thinking he could flip mutual funds 3 times a day. He failed his first practice test because he didn't realize your order just sits there until the market closes. It's not about speed, it's about the end of day math. So, watch this. You'll hear people say ETFs are just mutual funds that trade faster. While they're both baskets of stocks, the structure is totally different. The examiner will ask which one is continuously priced or traded on an exchange. That's the ETF. Mutual funds are redeemable, meaning you sell them back to the fund itself. ETFs are negotiable, meaning you sell them to another investor. It's the difference between returning a shirt to the store, mutual fund, and selling it on eBay, ETF. See the difference? People say no-load funds are free. The truth is they just don't have a front-end sales charge. They still have operating expenses and 12b1 fees. The examiner will ask for the maximum 12b1 fee for a fund to still call itself no-load. The answer is 0.25%. If it's higher than that, the no-load label goes away. What I see students do is ignore the small percentages, but on the SIE, 0.25% is the line in the sand. It's like a freeze app that still has in-app purchases. It's not truly free, it's just marketed differently. Okay? There's a myth that UITs are actively managed like mutual funds. Actually, they're unmanaged. The examiner will ask which investment company has a fixed portfolio. The answer is the UIT. Once the stocks are picked, they just sit there until the trust expires. There's no guy in a suit trading stocks every day to beat the market. This makes them cheaper to run, but less flexible. It's like a set it and forget it slow cooker versus a chef constantly tasting and stirring the pot. Right, quick reset. Options are the #1 reason people panic. They think it's high-level calculus. It's actually just a game of who has the right and who has the obligation. Let's debunk the fear. The examiner will try to trick you by asking which strategy a bullish investor would use, and they'll put buying a put as an option. You'll hear people say puts are insurance, which is true, but buying a put by itself is a bearish bet. You want the price to crash so your right to sell becomes valuable. If you think the market is going to the moon, you buy a call. The thing nobody tells you is that most options expire worthless. It's like buying car insurance, you hope you don't need it, but you pay for the right to use it if things go south. Now, here's the thing. The myth is that if an option is out of the money, it's worth 0. If that were true, why would anyone buy them? The truth is, an option can have time value even if it has no intrinsic value. The examiner will ask you to calculate the intrinsic value of a call when the market is below the strike. The answer is 0. You can't have negative intrinsic value. It's like a lottery ticket. On the day of the drawing, if you don't have the numbers, it's worth 0. But the day before the drawing, it's worth something because there's still a chance. Okay? People say options are only for gamblers. In the real world, big institutions use them for protection. The examiner will ask what the best protection is for a long stock position. The answer is buying a put. It caps your downside. It's exactly like a homeowner's insurance policy. You own the house, the stock, and you buy the policy, the put, just in case the house burns down. It's a conservative move, not a gamble. So, watch this. You'll hear people say you can only sell an option if you bought it first. Wrong. In the auctions world, you can sell to open. This is called being shorts the auction. The examiner will ask what happens when an investor writes a contract. Writing is just a fancy word for selling. You're taking the money now and taking on an obligation. If the other guy decides to exercise, you have to perform. It's like being the insurance company instead of the homeowner. You collect the premium, but you're on the hook if something happens. Let's review the key takeaways. Good luck with your exam. Click like and subscribe to the video for more free practice tests that can help you pass the exam. For more practice tests and study materials, visit FraserExam.com.